Hey, YouTube. Have you ever wondered why it seems that some individuals make 10 times, 20 times, 30 times, or even 100 times as much income as you do? What if I told you that wealth wasn't really measured in dollars and cents, but it was really more of a factor of time? And more importantly, what if I told you that most people never go on to create massive wealth? Not because of what they know and not even because of what they don't know, but it's usually because of what they refuse to question. A smart dude once said, the first time somebody sees an idea, a concept, or a notion, they generally only accept what they agree with. So I'll let that one sink in, and if it doesn't hit you right now, it'll hit you on the drive home from work today. So as you can see, the first enemy of wealth is not lack of money. It's the myths that we've been told about money. So today I'm going to talk about the 3 different principles that are absolutely essential and required in order to create massive wealth during your lifetime. And these principles, if they're ignored, they will keep that individual or that family in the slow lane on the path towards financial freedom and massive wealth creation. Hi guys, my name is Chris Hemmert. I made this channel and I named it For My Sons because it's for my sons. I wanted to be able to document all of the stuff that I've studied so hard to learn so that in the event that, God forbid, something happened to me, well, my sons would still have a trove of information and a way to get to know their dad. So this is my insurance policy. In the event that something terrible would happen, my primary objective is to share this information and this wisdom with my sons. I don't want them to struggle as much as I did. Of course, I want them to struggle, but I don't want them to go through all the unnecessary, silly struggles that I've had to go through. And then if somebody else or other individuals get value from this channel, I'm thrilled about it. But it's not my primary objective. Again, it's for my sons. So this is for you, Ryan and Reagan. So at this point, what I'm going to do is I'm going to define a few financial terms before we actually explore the 3 key principles that are essential and required to create massive wealth during your lifetime. This is such an important thing that we're going to do right here because wealthy people define certain financial terms differently than the way most people define them. And this is crucial. If it is a priority of yours to create massive wealth during your lifetime, then if your definition of the following words is different than the definition that wealthy people have with the same word, I would humbly offer that this is a great place to begin and a great place to reflect, because what you believe the definitions are, if they are different, they will lead to different outcomes than if you had defined them differently. So let's start with the word asset. Most people would define asset as anything that appears on a balance sheet, like anything that somebody owns. Some people might consider a vehicle an asset because it's... Now, I would say wealthy individuals define asset as something that can produce income. It appreciates in value and increases net worth over time. It's not just anything that appears on a balance sheet. So not all assets can produce cash flow, by the way. Now, the next financial term is income producing asset. Now, an income producing asset is something that generates cash flow without having to liquidate that asset. And so these types of assets, they provide recurring income while they appreciate in value, making these types of assets ideal for reaching financial independence. And then the last term, which is actually probably the most tricky, is the word liquidity. Now, most people would define liquidity as any financial instruments or assets that they can swiftly turn into cash in a very quick period of time. Wealthy people have various qualifiers on this term before they would actually call anything liquid. So for wealthy people, It's liquid if it does not incur any massive tax consequences upon the sale, any heavy penalties, any suffering of major losses, and then the final one is being able to leverage it instead of liquidating it. And now that's the trickiest one for most people to assimilate and understand. Wealthy people, if they can help it, they will never use their own cash. They will leverage their cash to use somebody else's money, thereby preventing them from having to liquidate their positions, which would interrupt the compounding growth of their asset. So liquidity is, according to their definition, is it doesn't incur any taxation, no heavy penalties, no risk of loss upon the sale. Think brokerage accounts. And then the fourth qualifier is it has to be able to be leveraged. Okay. Rich people sell things. Wealthy people never sell anything. All right. Now, here are a few core beliefs. And as I'm going through these core beliefs, just ask yourself privately if you believe these things. Because if you don't believe these things, again, this is another great chance, another great opportunity to reflect and just ask yourself, am I believing the right stuff if my goal is to achieve massive wealth during my lifetime? And again, you never have to justify to anybody whether or not that is something that you want. Okay. Now, so the first belief is prioritization of return of capital over rate of return. What does that even mean? Most individuals believe that they have to take a lot of risk to achieve high returns. And most individuals, they're always chasing high returns. And that's a belief that most folks have. Wealthy people they think nearly the opposite. It is more important for them to get a return of their capital, basically to be guaranteed or assured, at least, that they're going to be able to get all their capital back from an investment. It's more important for them to get their money back than it is for them to make money. So they're always thinking about worst case scenarios. And the worst case scenario is that they don't make money. But it is an intolerable risk to take to lose money. So they never put money in anything that goes down in value, generally speaking. I mean, you're going to find exceptions to the rule, but exceptions don't disqualify the general rule. The second belief that they have is they prioritize tax efficiency. Wealthy people are students, they study everything. They understand that the largest expense that they're going to incur over the course of their lifetimes is taxes. This is something that they know. It's a reality for them. So if they know this, and it is true, by the way, if they know this, then they put this really high on their priority list. They're always looking for tax advantage strategies or tax reduction strategies or tax elimination strategies. So they're always looking for tax efficiency. Every financial instrument, strategy, play that they're looking at is always through a filter of how does this play out in terms of taxes? Okay, so tax efficiency is a belief that it's a top priority of theirs. Is that a priority of yours? Does that even enter your calculus when you're looking at strategies? If not, guys, this is a great opportunity to revisit some stuff up here, right? Okay, stability and guarantees is another core belief of theirs. Wealthy individuals, they prioritize financial instruments that offer contractual certainty and long-term reliability. If they can determine that a financial instrument or a strategy is going to have long-term viability, that is extremely important to them. Just think about some of the accounts that people use a lot and ask yourself, does anybody know what those accounts are going to look like in the future? And I'm talking about a lot of the accounts that people use at their work. All right. I don't want to be too specific today. So stability and guarantees. A wise man once said that if you want to see how a financial instrument is going to operate in the future, if you want to have a really good feeling or understanding about how that thing is going to perform in the future, whatever it is that you're looking at, whatever strategy it is, this individual who happens to be a rabbi, he said, look at that financial instrument and look at its history of performance. And you've got to go back at least 200 years. So just think about any financial instrument. How has it performed in the past? Think bank accounts, stock market, cash in the mattress. How has that strategy performed over the past 200 years? That's enough time and data, according to this wise rabbi, to help you determine how that is going to perform in the future. I think that's great advice. All right, so now on to the 3 principles. So if you've made it this far, now we're talking about the 3 principles. I'm going to read them off. I'm just going to rattle them off. And then I'm going to go back and revisit each one very briefly, okay? So the first one is compound interest. The second one is leverage. The third one is velocity. Compound interest, leverage, velocity. All right, these are the 3. These are the 3 financial instruments that are essential, and they are required to create massive income over the course of one lifetime. You see, I say one lifetime because lots of individuals are chasing wealth using usually only one out of the 3 of these principles. This compound interest is the one principle that most individuals are using. But if you use only one and you leave 2 out, or if you're using 2 and you leave 1 out, one will not achieve massive wealth over their lifetime. It is nearly a physical impossibility. Somebody can go and win the lottery and they can disprove everything I just said, but that exception doesn't disprove the general rule. So, what is compound interest? That's when you're earning interest on both your principal and your past interest. The earlier you start, the greater the compounding over time. The next principle, leverage. That's when you use other people's money. It can also mean using other people's talents, skills, connections, that sort of thing. But in terms of this conversation, it's about using somebody else's money. This can take the form of getting a loan from a bank instead of using your own cash. So this is when people borrow against their assets. They get collateralized loans against their assets. It allows them to use someone else's money without having to liquidate their own net worth, thereby allowing their own net worth to continue compounding. So said another way, this is where you can get compound interest using someone else's money as well. It's a dual rate of return strategy, or some people call it the double dollar strategy. Your money can be in 2 places at once. The third principle is velocity. Velocity is what happens when you keep your money in motion. If one of your investments matures and you sell that investment, velocity is what takes place whenever you immediately reinvest the money. So reinvesting earnings quickly leads to maximizing growth, and the faster you deploy capital into new opportunities, the greater your wealth accelerates. So it's really simple. This is the trinity of principles required to create massive wealth over someone's lifetime. Now, leaving one of these principles out, some people think that they are smarter than they really are. And so upon hearing something like this, they'll say, you know what? I'm going to leave that one out. If you leave one out, listen up, Ryan and Reagan. I need you to listen to Daddy right now. If you leave one out, it weakens the entire system. This is where discipline comes in, and you have to have the discipline to to make sure you incorporate all three. If you incorporate all three with the right amount of focus on whatever it is that your mission on earth is, you can achieve, guys, anything. Okay. So this next phase of the video is where I'm going to talk about how to actually implement this process. All right. It is a 3-step process, and it is elegantly simple. The best ideas in the world are simple. If somebody offers you a very complex idea, run. The best ideas are always simple. Always, always simple. Lies are complicated, guys. All right, so this is the simple wealth building formula. We just went through the 3 principles: compound interest, leverage, velocity. Okay. The simple wealth building process is as follows. Step 1, fund and grow a stable asset. Ask ChatGPT what the various options are in terms of stable assets. I just don't want to be too specific here today, okay? But fund and grow a stable asset. So begin by using your earned income to fund as aggressively as possible a stable asset. The asset, you would be best served if the asset is tax efficient. It's got to be leverageable, meaning you can borrow against it. Some things you can't borrow against, but you got to be able to borrow against it. And this stable asset has to offer compound interest. So this has to be something that you can use true liquidity with, meaning you can leverage it without selling or liquidating your positions. Okay. Step 1, fund and grow a stable asset. Step 2, leverage the stable asset to acquire income producing assets, also known as IPAs. So you got to use strategic leverage, which takes the form of debt, to acquire income producing assets. You have to ensure that these assets create cash flow. All right. And this has to be a high quality asset. So I don't want to get too specific, but I mean, this could be acquiring equity in a business or an entire business. It could be real estate, duplex, fourplex, eightplex, commercial real estate, multifamily, anything that creates income while the capital value is appreciating over time too. So you got to keep compounding growth uninterrupted by avoiding unnecessary liquidation of your stable asset. So step 1 is you got to fund the heck out of a stable asset. Then you leverage that stable asset to acquire income producing assets. And then step 3 is you scale and accelerate wealth creation. What does that mean? That means that you use the cash flow and whatever earnings you accrue from the income producing asset, either through a refinance and pulling equity out or a sale. And whenever you do that, whenever you pull that cash out, you reinvest it immediately to create velocity. Now, most people would be tempted to take the initial capital event of pulling equity out of those IPAs. They would be tempted to take that money and pay off the debt that they incurred by leveraging the stable asset. But this is where discipline comes in. And I don't mean to complicate things for you guys, but I hope you're following along. Instead of paying off your debt and just being done with it, what wealthy people do then is they reinvest all of that new capital into more income producing assets. All the while, the cash flow from these IPAs is servicing the debt that was created when one leveraged the the stable asset. Okay? So the income from the IPAs is servicing the debt from the stable asset. From the stable asset. And when the reinvested earnings create a cash flow waterfall effect, it's at that point that wealthy people take that income from the IPAs to wipe out the debt. Okay? And then the unofficial fourth step is to repeat the cycle. Leverage the stable asset again to buy more IPAs. When those assets mature and you pull equity out of those, or if you sell them, you take all of that new capital and you reinvest those earnings instead of paying off the debt prematurely. The reinvested earnings in the IPAs create an accelerated or a multiplied cash flow situation, which that is used to pay off the debt. So as you can see, as I hope you can see, it is a wealth building, self-sustaining formula. It can operate all on its own. Okay. So what makes this process so elegant? Whenever you leverage stable assets and you create debt, you've essentially created wealth out of thin air. Let's say you make $100,000 a year at your job. That means it takes a year to create $100,000 worth of income after taxes. Okay? It takes a year of your life to create $100,000. Now, if you wanted to go and invest in something, but you knew it cost $100,000 to do it, and if you had no capital to your name, well, your only option at that point would be to earn that $100,000. And you'd have to wait that whole year. It costs a year of your life to do this. Okay? Whereas what wealthy people do, and another belief of theirs, is that they believe that time is immeasurably more valuable than money. They care more about buying their time back than they do accruing net worth. Like it's more important for them to get their time back. So what they would do instead is they leverage a stable asset. So they create $100,000 of income out of thin air in 5 minutes. Whereas the person who's not wealthy and who hasn't been trained, they're going to spend a whole year of their life to create that kind of money. Plus, leveraged income, meaning debt, that is tax-free. So a wealthy person in this scenario, they create $100,000 of income tax-free capital out of thin air immediately without having to spend a year of their life chasing that capital. Okay? That's one of the things that makes this thing so elegant. Now, if somebody was going to actually implement this process, they may find, and if they've never done it before, they may find that this whole thing feels really strange at first. It's going to feel extremely counterintuitive because now what they're going to do, if they're already doing what most individuals do, which is they park money in very popular strategies in the stock market, and they've been chasing these high returns. If all of a sudden they're told, stop doing that and fund a stable asset that is not going to be growing by very much, because by nature, a stable asset doesn't have a whole lot of variability in it. It's slow and steady. It's going to feel weird, and it's not going to make sense after someone's been conditioned for so long to be chasing these high returns. So the idea of placing your hard-earned income into a stable, albeit tax-efficient asset that offers modest, predictable returns, it's going to feel weird at first. And it's actually going to feel uncomfortable. See, most of us have been conditioned to chase high returns because we've been enticed to be chasing the excitement and the allure of these rapid gains in the stock market. If someone's been conditioned long enough, they may cling forever to what they know, closing themselves off from learning what they truly need, if in fact it's super important for them to create massive wealth over the course of their lifetime. So I once read a really high quality thought in a book that challenged me at just the right time in my life. And it goes like this. At some point in your financial life, you need to decide whether you want to chase a return or create a strategy. So my hope is that this is the right time in your lives to hear what once was the right time in my life, this statement, okay? So the realization that this works, at first, it's going to feel extremely uncomfortable funding a stable asset. It's going to feel uncomfortable, but it's necessary. See, true financial independence requires a shift in thinking, one that really prioritizes long-term stability and over short-term excitement. So how do you embrace this really strange concept all at once? Well, first you got to identify, where do you get your advice from? Where do you get it? Do you get it from your neighbor? The guy who lives right next door to you? The guy who seems to have an answer for everything? But if he lives right next door to you, that means that his thinking has brought him right next door to you. If you seek to be somewhere different than where you are, you have to develop a different way of thinking than his thinking, which got you almost the same address just next door. So genuinely valuable advice from a mentor is almost always counterintuitive to the mentee. If the advice immediately makes sense to the mentee, they would already be following it. If the advice immediately made sense to the mentee, they would already be following it. So thus, a mentor who only provides comfortable or agreeable advice isn't offering true growth opportunities. Good mentors challenge you, and they push you beyond your current understanding and your comfort zone. All right. Find the advice that makes you feel weird. I think that's a pretty good litmus test. Actually, here's a better litmus test. If you want dramatically different results than what you've currently brought into your life, you have to implement dramatically different strategies. If you want different outputs, you need different inputs. Okay? If you want to create a different external world, then you've got to create a different internal world. So here's the really good litmus test, or this has worked well for me. If you can have the discipline to stop, be at peace, look around, go inside your own mind, and ask yourself, what am I doing right now? Whatever it is, think about what you're doing right now. Is this the way most people do things? Think about however you raise your child, however you spend your free time, whatever your financial strategy is. Is this the way most people do stuff? Because if it is, then you're going to want to run in the opposite direction as fast as you can if you want to create a massively different situation for yourself. And if you want to create a massive amount of wealth during your lifetime, then you cannot do things the way most people have done them. Okay? So here's a really quick case study. Warren Buffett, okay? Arguably one of the best investors who ever lived. In early 2025, Buffett's company, Berkshire Hathaway, was reported to have about $334 billion on the sidelines, okay, in liquidity. And that he parks his liquidity in short-term U.S. Treasury bills. And that is truly liquid, because the last final qualifier of liquidity is that it can be leveraged. He doesn't always take debt against his treasuries, but he can. Okay? So he has money in the amount of $334 billion sitting on the sidelines right now. Okay? Waiting patiently for something that he believes is coming. This is a clue, guys. Okay? So how does he store his liquidity? Is he chasing high returns where he keeps all of his cash? Or is it in a stable asset? Well, I've already spoiled it. It isn't a stable asset. It's in short-term U.S. Treasury bills. What are those getting in terms of returns right now? Approximately 5%. Does that make you feel all giddy and excited? Like, do you immediately want to liquidate your entire net worth and just invest in short-term Treasury bills? Of course not. It's not exciting and it's not sexy. But it is a principle that you can't get away from if you want to achieve massive wealth during your lifetime. And this guy has. So he has funded a stable asset that he can leverage. Okay. So most people would agree, most financial professionals would agree that 5% is a modest rate of return. Okay. So as you can see, he's getting ready to use this capital to buy what he has always bought during every economic downturn: undervalued income producing assets. He buys businesses. His beliefs, it's more important for him to have preservation of capital, to make sure that whatever he invests in something, that he doesn't lose that money. His rules, his first two rules of investing are: 1, never lose money; 2, never lose money. Okay. Liquidity is important to him, tax efficiency, and leverage potential. Okay. So now we're at the end. This is what I'm going to share with you guys. I have a challenging thought for your financial future. Warren Buffett operates at a scale that very few people can match. Okay. But the underlying principles that he uses are undeniable, and they are exactly what I've just laid out here. Whether or not you decide to agree with what I've said is moot. No offense, guys, but it doesn't change the fact that this is true. So Tony Robbins is attributed with saying, the quality of your life is determined by the quality of the questions that you ask. So with that being said, I'm going to leave you with some parting questions. Is creating massive wealth a priority for yourself, your family, and your God-given purpose? It doesn't matter what anybody else thinks about that, guys. It just doesn't. All right, second question. What is the first thing that you do with your earned income? Are you funding an appreciating stable asset, which is leverageable, tax efficient, or are you spending it on expenses and liabilities? Does your current plan, does it have the 3 essential principles that are required for creating massive wealth during your lifetime? Or does your plan not even stand a fighting chance at that goal in the absence of those principles? And then, does your earned income flow into an asset first before being leveraged to buy income producing assets? Buffett's approach, it proves that massive wealth isn't about chasing returns. It's about compounding, leveraging, and keeping liquidity ready for the right opportunities. If Warren Buffett, the most successful investor of our time, believes in maintaining liquidity and leveraging stable, tax-efficient assets, what might you need to rethink in your own strategy? So guys, I hope this blesses you. Are you going to stay on the slow path on your attempt to creating wealth during your lifetime? Or are you going to change your strategy? Guys, I hope this blesses you. I can't wait to see you for the next one. Let me know what you think. Let me know what one of those beliefs is that you held on to for so long that you finally got rid of. And you were blessed because you did the surgical work of going in there with the scalpel and uprooting something that's been holding you back. And what did you replace it with? This is the stuff I love to hear about. Guys, you are all awesome. And those are not just empty words to say into a camera. My prayer is that these words hit you because they are true. They are true not because I'm saying them. I am simply acknowledging and agreeing with what he says about you. You guys are awesome. You just are. All right, guys. I can't wait to see you for the next one. Bye for now.